Guys, welcome to my channel Commerce Specialist, where you'll find videos relating to accounting and finance topics, covering syllabus areas of CA, ACCA, CMA, CPA, A-levels, O-levels, MBA, BBA, and BCom. Guys, I've received so many emails and messages from my subscribers asking me to make a video on basic accounting because there are so many people who doesn't have accounting background. So this video is dedicated to all those who are studying accounting for the first time. In this video, we'll talk about some basics of accounting. Yes, we'll begin with the definition of accounting, the 6 important elements of accounting, the rules of debit and credit, why they are considered important and how do they relate to accounting. We begin with the definition. What is accounting? Accounting is an art of recording, classifying, summarizing transaction and activities of business which can be measured in terms of money. So if you notice, I've used 3 important words: recording, classifying, and summarizing. Recording means we record everything we do in business. We cannot remember everything. So let's say if you talk about a grocery store, in a day you're selling so many things to so many people. Some are paying, some are not. So you cannot remember everything, you need to record. So that's the first aspect of accounting. We record everything we do. Number 2, classifying. Classifying means that in a month, if I have made purchases 10 times, I've sold 20 times, I've made certain expenses. So I'm going to classify them, separate them, purchases, all purchases together, sales together, expenses together. This is known as classifying. Summarizing means I prepare summary reports of what happened. And finally, in the end, we look at the interpretation of results. When it comes to interpretations, I've already made a video. The link is there in the description. It is on ratio analysis. That helps us to, interpret, which is in layman's word, reading the financial statements of a company. So ladies and gentlemen, without wasting time, let's begin with the basic accounting equation. The word basic means that, this is where we start from. In order to understand accounting, you need to know what is the basic accounting equation. Have a look at this, ladies and gentlemen. The basic accounting equation is like this. Assets equal liabilities plus capital. So whether you write capital first and liability later, it doesn't matter. This is an equation. Why we are calling it equation? Because there is an equal sign. It has a left hand side and a right hand side, and both has to be equal. So guys, if you look at the basic accounting equation, the very first element here is assets. We need to have a very good understanding of what is meant by the term assets. So first of all, I'll give you a layman's definition. What are assets? If you need to remember what are assets, assets are things which are useful for the business. So if you look around here, whiteboard, AC, laptop, furniture, phone, all these things are assets for me because I'm using them. So anything which is useful for a business is an asset of a business. I hope that is very clear. Another definition of asset is resources possessed and controlled by an organization. Resources mean useful thing. I use the word possessed, not owned. This is a misconception. People think that assets are what we own. No, assets are what we have, what we possess, and on what we have control. For example, I'm using this marker. This is in my possession now. It's not necessary whether this belongs to me or not. What is more important is, am I using this? Do I have control on it? Yes, this is my asset. So anything which is useful for a business, anything which is a resource for a business, anything which a business possesses, has control, that's an asset of a business. So anything which a business has, anything which a business has control on, anything which is useful for a business is an asset for a business. Now, some of the examples for assets are cash is the most important assets. Building, equipment, furniture, machine, you name it, anything which a business can use, possesses, has control over it, is an asset of the business. So I hope everybody understood what is asset. Now coming to liabilities. What are liabilities? Liabilities are obligations of a business. Liabilities are debts of a business. Liabilities in common terms are loans of the business. So liability is a huge word which includes obligations of the business, debts of the business, and loans of the business. So when I say obligation, that means what business has to pay to outsiders. For example, in my company, there are 15 people working for me. I have the obligation to pay their salaries. So if I have to pay, it's a liability. If I've purchased goods from somebody and I never paid them, it's my obligation to pay. We call it a debt. Or if I have taken a loan from bank, I have to pay back. That is also my liability. I have an obligation to repay. So if I have to pay somebody, whether it is because of the services I've enjoyed, like people working for me, I'm consuming their services, I have to pay for them. I'm using internet in my house, in my office, I have to pay for that. Liability. If I've taken a loan from a bank, I have to return back, I have to pay, it's a liability for me, for the business. So liabilities are obligations of the business. The third element here is capital. Now, what is the meaning of capital? Capital is not capital of a country. We are talking about accounting. In accounting, capital means investment made by the owner. Investment made by the owner into the business. So we all understand there are three categories of business: sole trader, partnership, and limited companies. So if I'm talking about a sole trader or a partnership, investment made by the sole trader into the business or the partners into the business will be known as capital. But when we talk about limited companies, public limited companies, investment made by the shareholders into the business is known as share capital. So we have assets. Assets are always equal to liabilities plus capital. Have a look at a numerical example. If a business has assets of 100,000, let's say it has liability of 70,000 and capital of 30,000. So I can say that I started a business, I invested 30,000, I took a loan from bank, that is my liability, 70. So in total, how much do I have? I invested 30,000, I borrowed from bank 70, how much do I have? 100,000. And 100,000, let's say it's in terms of cash. And cash is, money is what money does. Cash is the most important asset of the business. So this is how the equation balances. There is a possibility a business may have assets of 100, no loans, and total investment by the owner. There is a possibility a business have assets of 100, all is borrowed and nothing is invested by the owner. But down the road, the equation has to balance. So ladies and gentlemen, this is the basic accounting equation. Assets equal liabilities plus capital, where assets are the resources of the business, liabilities are obligations of the business, what we have to pay outsider, and capital is investment made by the owner into the business. I call this basic accounting equation. That means there is something more to it. Let's talk about that. So guys, after discussing the basic accounting equation, we are looking at the extension of it. And let me tell you, if you need to know accounting well, you need to understand the 6 heads of accounting, the 6 pillars of accounting, the 6 elements of accounting. The first 3 already you know: asset, liabilities, and capital. We're talking about the remaining 3: income, cost, and expenses. What does income means? Income means amount earned. I'm not saying received. Amount earned due to sale of goods and services. So if my business is selling cars, when I sell one car, whatever the amount I receive or I may receive is known as my income. Another word for income is revenue. Now, if you want, you can break this word income, the incoming cash due to sale of goods and services. Now, there is a possibility that you may not get cash immediately. Sometimes you sell on credit. So I may sell a car to one of my friend. If my business is selling cars, I sold a car to one of my friend and I asked him, you can pay me later. Fine, but the revenue is earned. I call it income. The incoming cash due to sale of goods and services. So if my business is selling cars, when I sell one car, the amount I receive or I may receive is my income. Cost is self-explanatory. Let's say the car which I sold to my friend, I purchased it for $10,000. So when I purchased the car for $10,000, that is my cost. I sold it for $15,000, that is my income. Have a look at a numerical example here, ladies and gentlemen. So let's say the cost price. I purchased a car for, let's say, $10,000. The same car which I purchased for $10,000, I sold it to, or you can call it a selling price, to a friend of mine for $15,000. That's why we have friends, actually, you know. So I purchased a car for $10,000. I sold it to my friend for $15,000. What is the difference? The difference is $5,000. Please understand the difference between cost price and selling price in accounting is known as gross profit. Gross profit. The word gross in accounting means an amount from which certain deductions are pending. Certain deductions are to be made. So when I say gross profit, from gross profit you have to subtract expenses of the business like rent, salaries, utilities, so on and so forth. So I'm assuming my expenses are $3,000, total expenses. How much I'm left with? What I'm left with is known as my net profit. 2,000. It is also known as net income. Net profit or net income is an amount which belongs to the owner or the owners. That's the residual amount, that's yours. So ladies and gentlemen, looking at this example, if I try to name these amounts, this 15,000 is actually my income. Or you can also call it revenue. Income and revenue means the same. So remember, I sold the car, how much money I am supposed to receive? 15,000. There are two possibilities. Either I have received the money or I may receive. In either case, it is known as my income. Income is the whole total amount. Then when we're talking about cost, cost by definition, it has two meanings. Number one, either it is cost of purchase. That means I buy car from somebody, I purchase it. So how much I purchase it for? 10,000. Or the second possibility is I have my own factory. I manufacture cars. So if I have my own factory and I manufacture cars, the cost would be cost of manufacturing one car. So there are two possibilities. Either I have manufactured the car, what is my cost? 10,000. Or I have purchased this car from somebody, what is my cost? 10,000. The same car I sold it to somebody for 15,000. That's my income. This 10,000 is my cost. We also call it cost of goods sold. So from selling price when you minus cost price, or from income when you minus cost of goods sold, you'll get your gross profit. Gross means there are certain expenses yet to be deducted. And these are known as actually operating expenses. What are expenses? Expenses are amount which are necessary to be incurred in order to generate your revenue. like rent, salaries, utilities, so many expenses. If you don't spend on this, how can you conduct your business? How can you run your business? So, profit. Now guys, understand, gross profit is 5,000. My expenses are only 3, which means my gross profit is more, expenses are less. If that is the case, I am making a profit. Alternatively, what if my expenses are 8,000? So if my gross profit is 5, my expenses are 8. So 5 minus 8, I'll guess negative 3. Negative 3 will be known as my net loss. So if your expenses are more than your gross profit, you may incur a loss. If your expenses are less than your gross profit, you are making a profit. I hope this is very clear. Now, putting these amounts into the equation on top, how do they fit in here? Assets, liabilities and capital, I already told you. So let's take a small example. I started business. I invested 10,000 from my pocket. I took a loan of 2,000. So how many my assets should be? 12,000. This is the status on January 1st when I started the business. I took a bank loan, I invested 10,000 from my pocket, and that's the total assets I have, 12,000 in cash. With this 12,000, what I did, I purchased a car for 10,000. I sold it to a friend of mine or a customer of mine for 15. Down the road, how much profit did I make? 2,000. Look at this, plus or minus. My income is 15,000. My cost is 10,000. My expenses are 3,000. So what is the net result of all this? Income minus cost minus expense. I'm making a profit. If there is a profit, can you see a plus sign here? That profit will be added to this, which is 2. Profits are added to capital. But if there was a loss, if I make a loss in the business, what happens? The loss will be subtracted. Can you see this minus? So whatever is the net result of income minus cost minus expense, that has to be adjusted with the capital. In case of profit, that would be added. In case of loss, that would be subtracted. And if it happens, if there is a profit, I add it to capital. Now what is my new accounting equation? My capital has become now 12,000. My liabilities are 2 and my assets would be 14. So please understand, profits and losses are either added or subtracted from capital. The next part. Please understand, if you need to master accounting, if you need to be very good at accounting, you need to be very, very clear about these 6 elements: assets, liabilities, capital, income, cost and expenses. If you know these well, that's all what is required. So whether you are in your O levels, you are your intermediate, in your high school, or you are doing your CA final, CPA exams, CIMA exams, ACCA exams, if it is accounting, we are talking about any one of them or some of them. That's it. Accounting is never beyond this. Every time in accounting, either we are talking about assets, liabilities, capital, income, cost and expense, some of them, all of them. That's what accounting is all about. Ladies and gentlemen, the next part. We have understood what are assets, liabilities, capital, income, cost and expenses. Now, the treatment. What do I mean by treatment? Let's discuss now. So guys, after discussing assets, liabilities and capital, income, cost and expenses, now we need to know how to record changes in them. Recording, because I told you the definition of accounting, it is an art of recording. So now we need to know if there are some changes in assets, liabilities and capital, income, cost and expenses over a certain time period, how to record them. So recording is an important element of accounting, and the very first thing, we need to do it right. So have a look at this. There is something we call Rules of debit and credit. What are rules of debit and credit? They are important to understand how to record changes in the accounting equation. For a while, let's assume we are studying mathematics. If I have an amount of 5,000 and I want this amount to be 7,000. So in mathematics, what we are going to do, if we want to make 5,000 7,000, we are going to add 2,000 to this. So this plus sign in mathematics is used to show increase. Likewise, if I have an amount of 8,000 and I want that to be 2, what to do? In mathematics, if 8,000 is becoming 2, if there is a fall in value, if it is decreasing, what we do? We minus 6,000 from it. So what we understand here is, in mathematics, plus is used to show addition, minus sign is used to show subtraction, decrease in the value. From 8, if I need to make it 2, I need to minus 6,000. From 5, if I need to make 7, I need to add. Plus and minus signs are used specifically in mathematics to show increases and decreases. But are we studying mathematics? The answer is no. We are talking about accounting. So in accounting, we do not use plus and minus. Instead, we use the term debit and credit. So how does debit and credit operate? Have a look at this. Let's assume I have cash 40,000 and I need to make it 45, for example. The cash is from 40,000, it is changing to 45,000 now. Increase in cash, we know that. We are not studying English, we are not studying mathematics, we are studying accounting. So the very first thing I need to know, what is actually cash? So for your understanding, I am writing that those 6 elements of accounting: assets, liabilities, capital, income, cost, and expenses, right? So this is how your processor should work, your thought process. When you're doing accounting, if you're looking at cash, from 40 it is becoming 45,000, we need to know what is cash. Is cash, how does it relate to these 6 elements? So we need to know the definition. What are assets? Assets are useful thing. Is cash is useful for us? The answer is yes. So that means cash is an asset, which means an asset is increasing. So ladies and gentlemen, according to the rules of debit and credit, whenever an asset is increasing, we show it as a debit. So I'll say, okay, please debit cash by 5,000. I will not say plus cash, I'll say debit cash. Because in accounting, increases in assets are recorded as a debit. Likewise, if I say I have cash 80,000 and I want this to be 60. So first of all, you need to know, you need to relate cash. Are we talking about expense, cost, income, capital, liability, or assets? Cash is highly useful for a business. So that suits the definition of an asset. Cash belongs to asset category. So, okay, if cash is an asset, what is happening to the asset? Asset is decreasing. As per the rules of debit and credit, we say credited. If 80,000 cash is 80,000, if you want to reduce it, you credit it by 20,000. That's how it becomes 60. So guys, we have rules of debit and credit in accounting to show increases and decreases in assets, liability, capital, income, cost, and expense. By the way, debit for increase and credit for decrease is not universal. That is for just few elements of these. Let me give you one more example. Let's say I'm talking about bank loan. Bank loan of $20,000. Now obviously if it's a bank loan, by definition it's a liability, because loan is an amount which we have to pay back. Loan means obligations of the business. So if I'm talking about a bank loan of 20,000, that means I'm talking about a liability. All right, what is happening to it? I have returned the bank loan. Now the balance is only 5,000. So how you should think now? First of all, what are we talking about? We are talking about bank loan. Bank loan is a liability. If it's a liability, what does the rule says? The liability is going down. What does the rule says? What does the rule recommends? Let me tell you, if a liability is decreasing, we debit it. Debit by how much? 15,000. Now if you look at, when assets are decreasing, cash is an asset. When assets are decreasing, we credit. But when liabilities are decreasing, we debit. That means the rules are different for assets and liabilities. Why? Because assets and liabilities are opposite of each other. Assets are highly recommended in business. Liabilities are not actually. You know, it's good to have assets in the business, but it's not good to have a lot of liabilities. Another example, similarly, if I have bank loan of 50,000 and the bank loans are increasing to 60,000. So first of all, what you need to have in mind, what are we talking about? We're talking about a loan. Loan is a liability. All right. So we are talking about a liability. What is happening to the liability? From 50, it is becoming 60. There is an increase in liability. Okay, if there's an increase in liability, what does the rule suggest? The rule says if there is an increase in liability, you show it as a credit. Increase in liability is recorded as a credit. So you credit it. So when you credit liability, they increase. But when you credit assets, they decrease. So guys, now I'm going to summarize the rules of debit and credit for you for assets, liabilities, income, costs, and expenses. That's the bare basic you need to master accounting. I would say after teaching accounting for about 24 years now, if you don't know rules of debit and credit, you don't know accounting. Because it will go a long way with you. Even if you're starting your O-levels, as I said earlier, or you are doing your CA final paper. Even if you are in your BCom or BBA, or you're doing your ACCA final paper, professional papers. If you don't know rules of debit and credit, you're nowhere. And this is what it is actually. Now I'm going to summarize the rules of debit and credit for you. Make it very simple. What happens when asset, liability, capital, income, if they increase, what does the rule suggest? Debit or credit. If they decrease, what does the rule says? So guys, summarizing rules of debit and credit, have a look at this. This is one group, asset, expense, and cost. Why I'm calling them one group? Because the rules of debit and credit is the same for asset, expense, and cost. Whether asset increases, expense increases, or cost increases, we are going to debit. We show it as a debit. When asset, expense, and cost decreases, we show it as a credit. Okay? Likewise, when you look at liabilities, capital, and income, this is another group. Why I've categorized them into one group? Because the rules are the same for them. Whether it be liability, capital, or income, if it increases, we record it as a credit. If it decreases, we record it as a debit. Ladies and gentlemen, if you need to master accounting, you need to have these rules of debit and credit on your tips. It's just like if you're fast asleep, somebody wakes you up and asks your name, without any hesitation, you tell your name. Likewise, if somebody wakes you up and asks you what is decrease in liability, you should say debit. So guys, rules of debit and credit is right in front of you. I've explained you what are assets, liability, capital, income, cost, and expense, the basic accounting equation, the extension to it, the meaning of assets, liabilities, and capital. So guys, this was all about the basics of accounting, the 6 steps of accounting, the rules of debit and credit. If you have any topics in your mind, please write it in your comment box so that I make the next video on that. Hopefully in my next video will be on recording of transactions and ledger accounts. So thank you very much for your time. If you like this video, please share it with your friend and family members so that others can benefit. Thank you so very much for your precious time.